What we're getting ready to look at is when Jerome Powell spoke last Friday. I want to say that was August 26, 2022. And what do we believe some of the implications are going to be from what he said. And what we're really trying to do is get people that are interested in this type of content, help give them some context to it, help give them something that's not going to be super overhyped, and help them kind of understand the benefit of listening to these type of conversations so they can prepare themselves, but also so they can put themselves in a position to potentially be profitable for what they believe is going to take place in the market. And not just the equities market, the bond market, treasuries market, the real estate market, it doesn't matter. But there's a benefit from listening to people that are coordinating the market as opposed to just reacting to it after it happens. And so the people that are going to be able to take this information and apply it are going to be the people that are going to see a benefit from it. The people that are going to be distracted while these things are going on because they don't necessarily get the emotional fulfillment from listening to this type of content, they're going to be left trying to figure out a situation that's going to catch them midstream when they could have been prepared for it before it took place. So let's go ahead and get right into the video.
Thank you, Peter, and good morning, everyone. Esther, thank you very much for the opportunity to speak here today. At past Jackson Hole conferences, I have discussed broad topics, such as the ever-changing structure of the economy and the challenges of conducting monetary policy under high uncertainty. Today, my remarks will be shorter, my focus narrower, and my message more direct. The Federal Open Market Committee's overarching focus right now is to bring inflation back down to our 2% goal.
So that's the first place that we want to stop the video to get some context. So he just said that their goal is to bring it down to 2%. So the question I would ask you is that where is inflation currently at? So based on where you believe inflation currently is at from a numerical standpoint, they saying they want to get inflation back to 2%. It lets you know how far they have to go. So then you can get an understanding of the job and the work that they have to do and the tools that they have to leverage or utilize in the economy to get inflation from where we currently believe that it's at to where they say they wanted to get it, which is this 2% threshold, this 2% baseline. So them saying that 2% inflation is the goal lets you know where we're currently at and where we need to go. And then what tools they may have to use or utilize to get inflation back to that particular goal. So what we do have is a goal set. So that's very important because then we're not dealing with something that's very ambiguous. So they're not saying that, well, we don't know where we want inflation to go, but we're going to keep trying to lower it until we feel it's low enough. They've let you know what they want their baseline to be. So this is really, really important. So let's get back to the video.
Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The burdens of high inflation fall heaviest on those who are least able to bear them. Restoring price stability will take some time and requires using our tools forcefully to bring demand and supply into better balance. Reducing inflation is likely to require a sustained period of below-trend growth. Moreover, there will very likely be some softening of labor market conditions.
Okay, so what he just spoke about is that reducing inflation requires below-trend growth. Therefore, we need to understand is what is the trend, and then we want to grow under that trend. And this is why this narrative that's being put out on the political side is that whether we're not in a recession or whether we are in a recession, which is based on GDP, is really not that important because the coordinator of the economy told you that reducing inflation requires below trend growth. Therefore, the goal is to create a recession because the recession, if you define it by consecutive quarters of negative GDP growth, or 2 quarters of negative GDP growth is not important if the coordinator of the economy is telling you that that's one of the things that they're going to have to do to reduce inflation. So their goal is to see below growth based on a particular trend line. And this is why these kind of conversations are important. So now you're not going to be able to get the Fox News affiliates. You're not going to be able to get the people with the podcast to come into this particular room and start asking him questions because they're not allowed to these type of events, even though this particular part of the event is public, because it's not a political event. It's an event for bankers. And that's what you got to understand. So I would encourage you to actually, if you actually want to be profitable in these particular type of events, right? You want to do what we call event-based trading. I would encourage you to listen to the people that make the decisions that are going to generate the event and not listen to the people that are going to tell you what you want to hear around the event. Let's get back to it.
While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses.
Okay, so we got it again. So we talked about softer labor market conditions are going to bring about pain. Now, what do we mean by softer labor market conditions? Most likely we mean unemployment, right? So we're already setting the narrative that we want below trend growth and we also want higher employment. And we've already accepted the fact that that's going to be painful for a certain amount of the population. All right, let's get back to it.
These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. The US economy is clearly slowing from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. While the latest economic data have been mixed, in my view, our economy continues to show strong underlying momentum. The labor market is particularly strong, but it is clearly out of balance, with demand for workers substantially exceeding the supply of available workers.
Okay, so we just heard him say essentially the same thing again. This situation's out of balance where the demand for workers exceeds the supply of available workers. And I think that's going over a lot of people's heads, right? The demand for workers is exceeding the supply of available workers. What are they looking for? They're looking for more workers than demand for workers. We talked about before, this economy, capitalism, is about creating surplus labor, right? It's about constantly trying to figure out a way to create surplus labor where you have more people looking for work than there's actually work that actually exists. And to get the average person to constantly have to chase work, right? Only way you think you're going to have some type of job security if you go to school for 20 years, or if you get a job that's very much in demand that a lot of people don't want to do. Like a lot of people don't want to drive trucks all over the country. Therefore, you can always find a job as a trucker. Now, it may not be the type of job you want. It may not be profitable if you try to, be your own independent contractor, but there is work out there for you. Other professions get phased out. There's way more people looking to do the job than the jobs that actually exist, or people just don't want to do the job. So you got to realize is that their ideal situation is where demand for work, right, is really less than the actual workers that exist, or is more even. What we're seeing now is that there's more demand based on their numbers than there actually are available workers, even though people are currently getting laid off. And it's because of the pandemic, a lot of the labor force got shifted into different areas. So we have areas where there are too many people working, and we also have areas where there's not enough people working because of the pandemic, in my opinion.
Inflation is running well above 2%, and high inflation has continued to spread through the economy. While the lower inflation readings for July are certainly welcome, a single month's improvement falls far short of what the committee will need to see before we are confident that inflation is moving down. So, we are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. At our most recent meeting in July, the FOMC raised the target range for the federal funds rate to 2.25% to 2.5%, which is in the summary of economic projections range of estimates of where the federal funds rate is projected to settle in the longer run. In current circumstances, with inflation running far above 2% and the labor market extremely tight, Estimates of longer run neutral are not a place to pause or stop. July's increase in the target range was the second 75 basis point increase in as many meetings, and I said then that another unusually large increase could be appropriate at our next meeting. We are now about halfway through the intermeeting period. Our decision at the September meeting will depend on the totality of the incoming data and the evolving outlook. At some point, as the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases. Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening policy. Committee participants' most recent individual projections from the June SEP showed the median federal funds rate running slightly below 4% through the end of 2023.
And, we want to take note that they want the federal funds rate, or what we call the cost of capital, to be around 4%. And that's going to impact everybody looking to get credit, people that don't really have great credit. So it's going to definitely impact the subprime market, even though it's going to allow people that are offering subprime credit to make even more money. Businesses that sell bonds that need to generate a yield, right? It's going to impact their ability to find a market for their bonds. So they're going to have to make their bond yields go a lot higher because they call the federal funds rate, I call it the cost of capital, to be around 4%, right? And so they're giving you a target of where they're trying to go in 2023. Let's get right back to it.
Participants will update their projections at the September meeting. Our monetary policy deliberations and decisions build on what we've learned about inflation dynamics, both from the high and volatile inflation of the 1970s and 1980s, and from the low and stable inflation of the last quarter century. And in particular, we're drawing on three important lessons that I'll highlight. The first lesson is that central banks can and should take responsibility for delivering low and stable inflation. It may seem strange now that central bankers and others once needed convincing on these two fronts. But as former Chairman Ben Bernanke has shown, both propositions were widely questioned during the Great Inflation period. Today, we regard these questions as settled. Our responsibility to deliver price stability is unconditional. It is true that the current high inflation is a global phenomenon, and that many economies around the world face inflation as high or higher than seen here in the United States. It's also true, in my view, that the current high inflation in the United States is the product of strong demand and constrained supply, and that the Fed's tools work principally on aggregate demand.
Okay, and I want to stop there because I think what he said is very important. So you have a high-level central banker explaining to you that current inflation is a byproduct or result of strong demand and constrained supply, right? Now, we've gotten a lot of narratives from a lot of people, and they're not dumb, they're not idiots, but I disagree with their analysis, is that the inflation that we're currently experiencing is a result of stimulus packages to the American public, right? Federal unemployment during the pandemic, state unemployment during the pandemic, the stimulus checks during the pandemic, right? But you got to understand, supply and demand works on supply and demand. It doesn't just work on demand. And one of the things that we saw during the pandemic was we saw constrained supply because our manufacturing partner, our number one manufacturing partner, which is going to be China, was shutting down manufacturing to deal with the pandemic. What it meant was that supplies were not accessible to the United States. However, there was still a demand on those supplies. So once inventories got extinguished, or once inventories were eaten up, there was no way to replenish inventories, but the demand still exists. And that's kind of how inflation works. So the goal of an economic system, a supply and demand graph, is to always try to figure out how to create price equilibrium, right? However, it's difficult to create price equilibrium when there's a demand for goods and services, but primarily goods, and there's not a supply available, right? And I want to really guard people in this very binary understanding of how economic systems work, to where we're at inflation because the government gave some people so much money. My question was, if I take the supply and multiply it by 5, would the money they gave out matter? So is it the money or is it the demand and a constrained supply? Because supply and demand works on supply and demand. Shortages work because of a certain type of deficiency in supply and demand graph, and the same thing with a surplus. So this is where we got to have some fundamental understanding. Now, you can make $1 million in business and not even understand basic macroeconomics because you're just good at business. But I would encourage you to just be good at business and leave the microeconomic analysis to people that kind of understand how that works. Also, the Fed's tool work on aggregate demand. So what he's letting you know is that our tools don't work on supply. Our tools work on demand destruction or demand creation. But our tools work currently now is they're trying to destroy demand or deal with aggregate demand. So I would encourage you to go look up what aggregate demand means. And that's one of the reasons why people struggle in the markets is because they don't seek to get a fundamental understanding of how markets actually function. It's easier to let somebody tell me what the situation is and I just run with that. But it means you can be very much misinformed because the question is, I can disagree with Jerome Powell, but he actually understands how supply and demand works from a fundamental standpoint. Now, I can disagree that inflation is transitory, right? However, I'm not getting the analysis that inflation is being created because we have a large amount of capital in the economy, right? And they're chasing goods and services without talking about what is the issue of supply of those goods and services that those dollars are chasing, because you can't have one without the other. Let's get right back to it.
None of this diminishes the Federal Reserve's responsibility to carry out our assigned task of achieving price stability. There is clearly a job to do in moderating demand to better align with supply. We are committed to doing that job. The second lesson is that the public's expectations about future inflation can play an important role in setting the path of inflation over time. Today, by many measures, longer-term inflation expectations appear to remain well anchored. That is broadly true of surveys of households, businesses, and forecasters, and of market-based measures as well. But that is not grounds for complacency, with inflation having run well above our goal for some time. If the public expects that inflation will remain low and stable over time, then, absent major shocks, it likely will. Unfortunately, the same is true of expectations of high and volatile inflation. During the 1970s, as inflation climbed, the anticipation of high inflation became entrenched in the economic decision-making of businesses and households. The more inflation rose, the more people came to expect it to remain high, and they built that belief into wage and price decisions.
And I believe that this was very important. What he also said is that there's an expectation of inflation in the consumer, and therefore that deals with wage and price decisions. So the actual consumer, the person in the economy, their anticipation or expectation of high inflation, it starts to modify their behavior in the economy. And therefore, we understand that inflation is not just a number on a piece of paper. It's the actual consumer's perception of what I can buy with my dollars, what my dollars will buy me. And if the consumer believes that we're in a high inflation environment, that now starts to dictate or has a potential to dictate their behavior, which can there bring about higher and higher inflation.
As former Chairman Paul Volcker put it at the height of the Great Inflation in 1979, inflation feeds in part on itself. So part of the job of returning to a more stable and more productive economy must be to break the grip of inflationary expectations. One useful insight into how actual inflation may affect expectations about its future path is based in the concept of rational inattention. When inflation is persistently high, households and businesses must pay close attention and incorporate inflation into their economic decisions. When inflation is low and stable, they are freer to focus their attention elsewhere. Former Chairman Alan Greenspan put it this way: for all practical purposes, price stability means that expected changes in the average price level are small enough and gradual enough that they do not materially enter business and household financial decisions. Of course, inflation has just about everyone's attention right now, which highlights a particular risk today. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. And that brings me to the third lesson, which is that we must keep at it until the job is done. History shows that the employment costs of bringing down inflation are likely to increase with delay as high inflation becomes more entrenched in wage and price setting. The successful Volcker disinflation of the early 1980s followed multiple failed attempts to lower inflation over the previous 15 years. A lengthy period of very restrictive monetary policy was ultimately needed to stem high inflation and to start the process of getting inflation down to the low and stable levels that were the norm until the spring of last year. Our aim is to avoid that outcome by acting with resolve now. So, these lessons are guiding us as we use our tools to bring inflation down. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply and to keep inflation expectations anchored. We will keep at it until we're confident the job is done. Thank you.
And there's also one thing that he talked about that I may have overlooked over the last 2 minutes is that they're interested in price stability and not volatility, right? They don't want the American consumer to leave their house and every time they go to the supermarket or they have to, get services, that they believe the price is going to be different. They want a level of price stability across the market. And that's something that they're looking to do. And they understand that inflation, but also supply chain issues, which they have no control over, can impact those particular things. And that's pretty much what the conversation was about. Now, we understand after he came out with this particular broadcast, it only lasted around 10 minutes. While this broadcast was going off, the market was selling off because people's anticipation was that he was going to have a little bit of a softer tone on raising the cost of capital, but they call the Fed's fund rate. And this is why these particular conversations are important, right? When you understand how the system is actually constructed, you understand the people that are actually in control of the system, right? Therefore, I look to those people to try to figure out what direction things are going to go into, as opposed to looking at the people that don't have the control, but they're kind of being created as sounding boards for the public. Hope you got some value from this video. David W. Williams, talk to you later.